Hi, this is Dora DeLellis with ThoughtsOnTheMoney.com. Welcome back to my vlog. For today's 10-year flashback, I want to talk about the job loss situation and how it was affecting employees. It was reported back in 2009 that 10,000 people a day were losing their jobs. Job losses meant that people stopped spending money, furthering the damage to the economy. It almost seemed like there was no way out of the disaster. As you can see from the second image that I presented, that consumer spending was way down. Consumer spending supports the economy at a rate of about 70%. So you can see how job losses and reduced spending were going to delay economic recovery. In addition, average people not only stopped spending, but were struggling with accumulated debt. Job losses were basically daily news of the day. I remember being at my follow-up job for only about 2 months when I received 2 cell phone calls from 2 friends who had both lost their jobs in the same week. Many employers handled it poorly, witnessed by the remaining employees. Survivors were also burdened with the workload of disappearing coworkers, causing anxiety and depression. If you were let go, you weren't happy, and if you were not let go, you probably were also not happy. I think no one wanted to talk about it, but the job losses were expected to continue, which they did for several years following the crisis. The job market since then has been watched carefully for the last 10 years with heightened sensitivity. The definition of unemployment, was forever altered as many people were forced into retirement or simply stopped pursuing employment. Those individuals ultimately fall out of the equation. Therefore, when unemployment was reported, it left a lot of skepticism. Well, I don't know about you, but that's enough gloom for me right now. So let's move on to today's topic. Following my last vlog session, I reported that I would be speaking about fiduciary issues. And I'm not sure everyone knew what I was talking about, or it may have sounded like something so foreign or boring that it was a turnoff. I can promise that it's not the most exciting topic, but it's something that affects your lifetime wealth. Does that have your attention now? I hope so, because there are unscrupulous people that are waiting to steal from you. They don't do it with a gun, they'll do it with a briefcase, and they do it in such secretive methods and by keeping you in the dark if you're uninformed. With pensions drying up over the last 3 decades, they were replaced with qualified retirement plans and put the burden on employees to save for their retirement. These are otherwise known as employee 401k plans, so that everyone is encouraged to contribute to the maximum. So far, so good. What happens next is that the employee is given a menu of investments to allocate their money into, then work for the rest of their life through their full retirement age. For those not paying attention, which most people aren't, the investment accounts may not be appropriate for them or may be assigned to a financial advisor that is earning exorbitant fees. So here's where it might have stronger meaning. Let's say you work your whole life and your 401k investments accumulated a value of $400,000. According to the White House Council of Economic Advisors, a study released indicated that excessive fees and hidden conflicts of interest lower annual returns by 1 percentage point, which over 35 years, which is about the average employment time horizon for retirement savings, reduces a person's wealth by a quarter. Because of high fees and commissions, throughout the years, your $400,000 account would have been siphoned down to $300,000. That's 25% of value that would be yours to enjoy in retirement. So do you know where your money is and what your management fee is? While everyone assumes that a financial advisor is supposed to work in the best interest of their client, that may only be partially true. For all the investment funds that an advisor recommends, those funds may be to your benefit, but they may also help the advisor cash in on big commissions and hidden fees. That's what's known as conflict of interest. They're using your account to bleed it for every penny of fees that they can get their hands on. So the fiduciary rule that I was referring to was created to ensure that financial advisors act in their customers' best interest. Isn't that what they're supposed to be doing, you may be asking? Yes and no. They're doing what's in your best interest, but they're also doing what's in their better interest. What that means is that they're investing your money, but investing it in financial instruments that earn them the highest commissions and fees. The fiduciary rule was meant to require advisors to disclose conflicts of interest and provide a website to teach clients how they, the advisors, make money. After delayed adoption in June 2017, the regulations were further subject to review, but triggered lawsuits along the way. Ultimately, in true Trump fashion, the proposed regulations and fiduciary rule were scrapped. Reasons against the rule went from burdensome compliance to a significant decrease in products to be offered for adequate diversification. For whatever reason they asserted, the ramifications to the public should be emphasized. So this income stream and the commissions and fees that the advisors earn basically put their income revenue, their revenue stream of these fees on autopilot. They basically may be doing some periodic reallocation, but by having your money in the account and having them assigned as the investment advisor, it will periodically, either on a quarterly basis or annual basis, be earning them the fees. Everyone's getting paid, the mutual fund company and the financial advisor. And I don't mean to bash any of my colleagues, but when there's no transparency and there's a little bit of money at a time, which is barely noticeable, the cards are stacked in their favor. So really that 1% that doesn't sound like a lot, it really accumulates over time and compounds. So the money that you work for and that comes out of your paycheck every time that your pay is earned and gets contributed to that account is funding someone's lifestyle where they're really not doing much to earn it. So we're talking about $17 billion. That's right, with a B. That's how much asset management fees take on an annual basis. I fired my financial advisor almost 4 years ago, and since then my portfolio has been earning 10 to 15% a year. He bragged that it was earning 8% and I was netting 6% after fees. But I was never entirely clear because the fees are not clearly displayed on the statements. On some of my investments, I was unknowingly paying two sets of fees on the same money. Here's how that happened. When I transferred money to my wealth advisor's account, I wanted to keep a Vanguard fund that I'd had for many years. They gladly accepted that fund. What I didn't realize is that Vanguard takes a fee for the investment account, and so is my financial advisor, on the same money. I called Vanguard to confirm the stupidity. And this is basically what happens with all funds, unbeknownst to the account holders. So any of the other funds, and I'm not going to name any specific ones, but any actively managed funds are they have investment advisors that run those funds. They take their fees first, and then the investment advisor that puts you into those funds also takes an asset management fee, just based on the balance. They're really not doing that much work to earn that. They're not making any daily decisions. They're not watching your portfolio every day. And one other point that really disappointed me about my investment advisor was that he wasn't giving me additional points of advice, such as he could have made an effort to tell me to contribute to a Roth IRA or make non-deductible IRA contributions. As an employed individual, I'm not eligible to make a traditional IRA contribution and get a deduction for it, but there were other ways that I could have been putting additional money into tax-deferred accounts, and he didn't even bother to tell me that, so that was really disappointing. Also what happened was I had a number of accounts with several hundred shares. They were corporate stock holdings. And what really would have been ideal is if those dividends were reinvested to earn additional and purchase additional shares. And if I hadn't wasted about 6 or 7 years, about 6 or 7 years of ignoring the dividend reinvestment factor of that stock holding, I probably would earn a lot more shares than I am now. And since 2015, when I fired the investment advisor, I went from 500 shares to having almost 600 shares now in about 3 years. So I really wasted valuable time. And that's the whole point in investment advisors telling young people to really diversify and take risks, because you have a very long time horizon and you don't want to waste years. Okay? So now moving on to figuring out how much in investment fees the active managed funds are taking. It's very hard to find it on the statements. And what happens is they'll take the fees before they even report your returns. So you won't see it. What you have to do is look into the prospectus and the very important information of the fund that you're involved in, and look for the investment management fees and look very carefully. Otherwise, you won't have any idea of how much in investment fees that you're paying. Compounding also is not just for interest-bearing accounts, whereas when you invest $100 at 5%, then the following year you have $105 to invest. Compounding can be in the form of reinvested dividends, which I just spoke to, and it will increase the shares of stock of a certain mutual fund or single stock investment. Here's also some insider information. When the fiduciary rule was pending in 2017, I attended an all-day conference of the Financial Planning Association. The keynote speaker at lunchtime addressed the fiduciary rules. Now, I've been to many professional conferences in my career, and the latest or pending regulations or the latest news is always spoken about by the keynote speaker. But this was the first time in my life I've ever heard such inflammatory language towards a prospective rule. And what really triggered this anger and this reaction, to me, my impression is that it was rather unethical, because I could understand the reaction. It was basically taking away the livelihood of these people that earn their living from assets under management. But at the same time, I felt it was a little bit unethical, because it gave them an open door to charge higher fees or to put their clients into investments that earn them very high commissions, and really not be very transparent about it or not lay out all the facts such that they would understand what they were that they were investing in. So by avoiding disclosure and being adverse to acting in their client's best interest, it seemed that they were adamant about maintaining free rein to siphon money out of their clients' investment accounts. The rule would severely limit their revenue streams and basically take money out of their hands. So the amounts are staggering. U.S. retirement assets are at around $28 trillion as of the first quarter of 2018. That's sizable amounts that they really don't want to have to reduce their fees and their commissions on. I can understand the reaction. In light of the rule and its reversal, certified financial planners, which are licensed by the CFP board in Colorado, and that's a federal group, it's not state mandated. There's only one U.S. group and that oversees the CFP license. So they've committed to being bound to the fiduciary rule, regardless of what was decided in the courts. Other investment firms have jumped on board to gain credibility, but regardless, here's what you should be doing. Take a look at your retirement accounts. What are you invested in? Do you know? Are they appropriate for you? Do you know how much in fees you're paying? Is it higher than 1%? I'll give a good example of comparing fees. If you're paying 1% or higher, you could have your money invested in a Vanguard fund where the fee may be 0.05%, which is 1/20th of 1%. So if you're paying 1% or higher, you're paying 20 times the amount that Vanguard would be charging you. I also learned that Vanguard is a nonprofit organization. I didn't realize that until I started asking a lot of questions. That means that they're not in the business of charging exorbitant fees to earn profits from their clients. So there's also a way to see the underlying investments of a mutual fund or an index fund. Look at the page or tab that says Top 10 Holdings, and you'll be able to see the major investments of that fund. And also look for the page that shows you the annual fee percentage. It's really not that hard to find. Ask the right questions, and if you can't find what you're looking for, keep asking until you get a clear answer. Are you paying double fees anywhere like I was? You don't want to be doing that. Look, I know you'd rather be doing something else, and this is really not terribly exciting. On the next rainy day when you have nothing else to do, take some time to track down your 401k, your IRA statements, and any other funds that you're invested in. Pull everything together. Do it a little bit at a time. And if you can't find everything all at once, put it aside and just keep looking and just get everything together, get organized, and you will find it. So, of course, over your lifetime working years, you could come out with an additional 25% of wealth in your accounts, but it's up to you to safeguard it. No one's going to do that for you. Don't expect your employer's fund manager to call you and point out that you're paying him or her or their funds or their employer extra fees. Don't expect them to tell you that by buying an annuity product that they just won a trip to Amelia Island in Florida. And that's actually based on someone that I knew that worked for Bank of America. They won a trip with their coworker to go to Amelia Island in Florida, which is actually a really beautiful place. But they earned it by the number of annuities that they sold. And the reason for that is that an annuity is notoriously known for charging high commissions for entering into that annuity. So that's an example right there. Okay, I want to move on to today's second topic, which is investment ideas by risk category. So I hear over and over, I want to invest, but I don't know how or where to start. So here are some ideas where to start. And if you think about it in terms of risk, it may narrow it down to a few simple choices. So if you look at low risk, medium risk, or high risk assets, especially if you're hesitant to start investing or you don't know where to start, this may be a good place to have your benchmark of where to start putting money. And as you feel more comfortable, you can branch out, and as you continue reading and learning, you'll learn how to diversify your assets, and you'll feel comfortable entering into other investments as well. So your low-risk assets are assets that preserve wealth. These are basically savings accounts, money market funds, CDs, cash equivalents that I just mentioned, municipal bonds, and TIPS, which are Treasury inflation-protected securities. So if you park your money there and start building that up, eventually you will want to take on more risk because you'll be losing out by just having the money there. You'll be losing out by not being in more aggressive investments that might earn you a higher return. So this is where it starts to get fun. If you enter into medium risk investments, you'll be looking at stocks, ETF, which are exchange traded funds, and mutual funds that blend stocks with bonds. I highly recommend looking at the Vanguard site and blending high risk with low risk investments. It's really not that hard, and you can be very simple about it by just having maybe 3 funds putting your money into 3 funds, splitting it up in that manner, contributing more as time goes by, and not having to worry about it. Okay? Now, if you're talking about high risk investments, we're talking about maybe IPOs, experimental businesses, startups, junk bonds, and cryptocurrencies. I talked about cryptocurrencies in a previous vlog session, and the reason why they're so risky right now is that they're unregulated. And the activity has been going from maybe what looked like a pump and dump. And what's a little bit scary about these cryptocurrency investments is that there are very few people that are basically controlling the price of the cryptos. So if you do invest in that, you only want to invest what you're able to lose. So be careful with that. Although, on the flip side, I think there's a tremendous wealth opportunity. That's why the diversification is a very popular term that's thrown around, because you want to spread your investments between low, medium, and high risk. So I highly recommend looking into the low risk investments and start getting comfortable. But don't be foolish and get drawn into penny stocks or cryptocurrencies as your main investment. That really would not be smart. And I realize, looking at a very long working career or a long life of working is not terribly enticing, where you'd rather maybe invest in things that you think are going to give you a quick turnaround and make you a millionaire quickly. That's really not smart. I know I did that to a certain extent when I was younger, and it really didn't work out very well. So take your time with it, learn, but start and do something. So just to wrap up, my questions are, in the investments that you do have right now, and in the 401ks and other retirement assets, take a look at what you're invested in and get to know your investment expenses and what you're paying, and start investing, because it really is the only way to leverage your current income for wealth accumulation. So thanks for joining me today. Please leave comments and questions on the thoughtsonthemoney.com website, and I'll see you soon.